Gentlemen, happy Friday. Good to see you. Nathan, your thoughts on CPI and not to be Goldilocks, but your reaction to some who say PCE is unlikely to be as bad, given some of the different component construction. Is that going to offer any kind of relief in the days to come?
I think the bottom line from today's CPI report is inflation is hot. It's not going anywhere, maybe sideways, but it's certainly not going down in any convincing way. We are seeing a bit of a reprofiling of the inflation process from goods more into services, so there's some compositional change. But this is an inflationary environment, and whether you calculate that inflation looking at CPI or PCE, quite frankly, I think you've got to come to the same conclusion, and I think it's the conclusion that the Fed will come to next week, and that is we've got an inflation problem. It's cutting into consumer confidence. It's cutting into spending power, and the Fed's got to tackle it.
Darrell, your thoughts on what that means for the Fed rates and then obviously equities response?
Well, it clearly means, the biggest repricing this morning has been now we're pricing in, the consensus is 50 basis points in September. We already had priced in 50 for June, 50 for July, and there was a growing probability of 50 in September. And now that looks like, if you look at Fed funds futures, it becomes the consensus. The bottom line is you can look at CPI backward looking, you can look at PCE backward looking. If you simply look at the bond market and the yield curve, it is telling you that it doesn't believe peak inflation and it doesn't believe peak yields yet. Whether it's, the 530s inverting briefly this morning, and that the central bank is behind the curve and needs to do a lot more. Even if you want to go to neutral or suggest tight, it suggests short-term rates have to be above wherever the rate of inflation is, and we are a long, long ways from that point.
Nathan, that would certainly seem to be the case if the market is not signaling it sees a peak in these dynamics. But I think if you go down that chain and you get to the point of, well, the Fed has to become restrictive, the market maybe is saying that something might break before we get there, or perhaps the economy would slow enough along the way that would be the thing that helps to restrain inflation. And that to me explains why the market-based inflation measures have not really raced higher, in fact, are off their highs. Does that make sense?
That makes a lot of sense. I think that is this dynamic of how much hiking can the economy absorb is what the markets are wrestling with at the moment as they seek to factor in some negative earnings and soft earnings reports we've received from some of the retailers. How strong is the consumer going to be in this environment of rising rates, high energy prices, and rapid inflation? And I do think that there is a legitimate risk that the consumer, which at the moment the consumer sector looks to have a fair amount of steam, but these headwinds are mounting and they are significant. And the consumer may lose momentum, before the Fed gets the Fed funds rate above the rate of inflation. And I think that's what the markets are wrestling with and seeking to price in at the moment.